Hello, it's Chelsea and Nick Jerusalem with the Jerusalem's Happy Home Team. And today we're here to discuss a topic that's been kind of a buzzword that's been around recently. We've been hearing the word recession.
That's right.
We just have been in our longest running economic increase in history. And it's been over 10 years of improvement. And so what would a recession have as an impact on our market?
That's right. So, and stock market's up over 50% since 2016. Unemployment's currently at 50-year lows. And so you kind of think, well, it sounds like everything's pretty good. So where is all this recession concerns coming from? Well, so a couple indicators. One is that back in July, the Federal Reserve cut the federal funds rate for the first time in over 10 years. So the longest span, second longest span rather in recorded history. And so that's usually done as sort of an economic stimulus. It lowers the overnight rate, so it kind of lowers credit card rates. It's designed to encourage consumer spending. Then we also saw an extremely volatile August in the stock market, and then on August 14th we hit the dreaded inverted yield curve. And so basically that's when the yield on a 10-year treasury dips below what you can get on a 2-year treasury bond. So kind of the idea is that short-term money is providing a better return than long-term investment. So,
and the last 5 times that we've seen this inverted yield curve, it has been followed by a recession. So that's kind of where the fear has been coming from.
that's right. And so we can kind of look at what's happened in these little recessions here, not little bit, in 1980, from 90 to 91, in 2000, 2001, and then again in 2007 to 2009, which is these gray periods that indicate the recessions. How does that correlate to what was happening with home prices locally? So
Right,
this is
exactly. Because what was the real estate market doing? We have history of these recessions. So how did that impact our real estate market when we had these past recessions?
That's right. So this is looking at King County over the last 34 years, and you can kind of see that in the early 90s, the savings and loans crisis, home prices flattened. They got down to basically zero growth, but never actually declined. And then in 2001, we had the dot-com bust and still all the fallout from 9/11. And that was the other recession period where home prices actually went up 4% during that time. And then from 2007 to 2009 was kind of the beginning of the Great Recession, as it's been coined. And that is very significant because you see there was a big decline in home prices, but that recession was driven on by fraud, specifically within the housing market. So very different landscape than where we are today. Right. So now we have to kind of wonder, well, what else can have an impact, right?
Right. So really the only thing that would dramatically impact or cause a recession to have an impact on our economy or our real estate market would be if we had a dramatic increase in supply or decrease in demand, or both.
That's right. So what we're looking at here is seeing what home prices have done over the last 10 years in the Tri-County area. So you have King up top, Pierce and Snohomish is well represented. So you can see King County has been largely flat. It's only up about 2% from last year, and it's been pretty much kind of plateaued for about the last 18 months. So an indication that we've already hit that ceiling of what jobs in the area can afford. And whereas you've seen that Pierce and Snohomish still seeing strong appreciation in their prices because there's great affordability there. So you're seeing more and more folks drive a little further out to qualify. And so there's still more runway for those markets to have more future appreciation. Mm-hmm. And then from the supply side, so we literally had almost 3 times more homes for sale 10 years ago than we do today. So even though you can see here, it shows this big spike for King County that is up 48% from a year ago, where that's still 1/3 of where we were 10 years ago. That was about 18,000 homes for sale in 2009 and compared to about 6,000 today. And then Pierce and Snohomish, you can see that their inventory, Pierce is actually declining. So a further indication that there's strong demand for affordable housing right now. And Snohomish is up a little bit, kind of following King County. So that's kind of where our supply and demand has gone with housing.
Right. And in that same 10-year period, we've seen almost a 500,000 new jobs added to the Tacoma, Seattle, and Bellevue metro area. So
right.
Lots of new jobs, and unemployment has also in that same period gone from the peak in 2009 of like 10% unemployment rate to now we're at 3.6%. So super low unemployment rates going on right now. So things are looking good.
Yeah, so that's kind of our local where things stand currently with jobs. So what does the future forecast look like for job prospects
Magic
here?
crystal ball time, guys.
Yeah, so as of the beginning of the year, Seattle led the nation again for 3 years in a row for the most tower cranes up in the United States. So you had 59. It's now tied with LA. You have an additional 15 tower cranes across the bridge in Bellevue. The vast majority of these are commercial, mixed use, or hotel spaces. About a third of them are residential projects. So that means that a lot of these are going to be new jobs that are going to occupy these buildings. And 3/4 of a lot of these commercial projects are already leased currently.
Yep. So the jobs are coming, the buildings are being built for the jobs, but where are these people going to live?
That's right. And then the last factor that could impact demand. So we see job growth is strong and looks like will continue to be strong years ahead due to all this construction pipeline. And then mortgage rates right now obviously also can, of course, have a big impact on people's buying power. And so rates right now are 3.5%, give or take, and that's the lowest they've been in about 3 years. They hit as high as almost 5% just November of 2018.
Yes, and interest rates can have a huge impact on what somebody's purchase power would be. A 1% change in interest rate is the same as a 10% swing in purchase price. So that can make a huge impact on what somebody can afford as a monthly payment, which is really what people are kind of basing their affordability on. So if you're sufficiently confused, if you are wondering what should I buy, should I sell, what does this mean? This market is our market is very, very local. So it depends on where you're going to be and what your goals are, and it's changing every day. So really the best advice is for you to talk to somebody to consult what your goals are and how best to get those accomplished and what this could impact what your goals are. So we're always happy to counsel you one-on-one to make sure you know what you're trying to accomplish and how best we can get you there. HappyHomeTeam.com.
HappyHomeTeam.com.
Call, text, email.